This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, welcome to episode 279 of the AJ Bell Money and Markets podcast, the show that's full of insight into what's moving on the markets, what investors are thinking, and how you can stay on top of your personal finances. My name is Dan Coatsworth, and joining me this week is Danny Hewson. Hi there, Danny.
Hi, Dan. We've also got three special guests on this podcast covering a range of topics, including AJ Bell's Rachel Vahey on the pros and cons of deferring the state pension, and Rockwood Strategic fund manager Richard Staveley on the art of investing in small caps and why he's supportive of plans for a UK ISA.
And we'll also hear from Ross Driver on why Foresight Solar shareholders will next week vote on whether to keep the investment trust going or wind it up.
We've also got some interesting stats on how the nation is still obsessed with cash ISAs. More on that later. But first, let's talk about what has been going on in markets over the past week. And it's been pretty volatile, Dan.
Yeah, I mean, I took a couple of days off in the last sort of week cycle. Just before I went on holiday, it was looking very miserable, and come back and actually it's sort of picking up again, which is quite nice to sort of record this on a sort of a more positive note. One of the key things that has given the market a bit of a wobble is that we saw Brent crude oil prices fall by more than 3% on Monday to just below $78 a barrel at one stage. So this is on market speculation that some of the major oil producing countries that are part of the OPEC group, it's like a oil producers cartel, and that includes Russia and Saudi Arabia, was set to ramp up exports later in the year. So if you go back to last weekend, OPEC agreed to extend most of their oil output cuts into next year. But they did leave some room for voluntary cuts from 8 members to be gradually unwound beginning in October. So we saw this wobble with oil prices. That then continued on Tuesday. And investors are sort of here, they're just worried about supply rising later in the year, just at the point that we're seeing weakening US demand. So we had some manufacturing stats from the US that showed activity slowed for a second straight month in May. Construction spending in April fell for a second month as well for non-residential activity. And of course, both of those could translate into weaker oil and fuel demand. So I guess there's good and bad ways of looking at this. It's you might think it's actually quite good because we've got a falling oil price implies sort of, we want inflation to come down because that would lead to interest rate cuts or when you go to fill up your car at the tank, because petrol should be cheaper. But actually, just as all this was happening, wholesale costs for natural gas hit their highest levels across Europe since December last year. And of course, that threatens a spike in your energy bills. And this is linked to news that a key Norwegian export operations had to be shut down due to a cracked pipe. So, as always, this situation, just as you think you're getting your head around like what's going on in the markets, something else comes sideways and knocks it for 6. But just say as we're recording this today, we're recording it on Wednesday. Everything looks like it's sort of settling down a bit. Of course, that might change by the time you listen to this podcast. So, Danny, obviously retail is the big thing in terms of companies reporting. We've had loads, haven't we? Inditex, we've had W. Smiths, B&M. What's the sort of the general sort of theme that you've been seeing there with the retail sector?
It's really interesting because there does seem to be quite a mishmash of performance from the retail sector. Let's just talk about overall, because we had some figures out this week from the British Retail Consortium and also from Barclaycard, which gives us a really good indicator of where people are spending and how much they are spending. And unfortunately, after a really gloomy month last month, May did a bit better, but not massively better. So it was a 0.7% rise in retail sales in May, up from April's 4% drop. Now, A lot of that was down to the fact that we had a couple of bank holidays. A lot of people were spending money on food and also DIY projects. As hurrah, we finally had a little bit of good weather. But also the data from Barclays, which has about 40% of the UK's debit and credit card transactions, it found that retail spending fell 0.4% over the month. Now, that's the sharpest decline since September 2022. A lot of sluggish spending in clothes sales, and really sort of illustrating that households are still incredibly cautious about where they're spending their money, whether or not they're going to splash out on stuff that they don't need but just would kind of like. And remember, in April, despite the fact that we got that national insurance cut and got an increase to the national living wage, an awful lot of bills also went up. And I'm thinking about council tax and broadband. The broadband costs have just been incredible. And car insurance, we've spoken about that before. So that has really sort of impacted people's ability to spend. I want to start with the bad, and that's JD Sports. Now, I say bad because it is still doing incredibly well. We are talking about sales of £917 million. That's profits, rather, not sales. 917 million. Sounds like a lot, but it is way, way, way below the £1 billion mark that it had hoped for just a year ago. And last year, you were talking about £991 million worth of profit. So that did impact share price upon publishing those results, though it was really quite interesting because in the days leading up to the results, the share price had gone up, and actually, despite them dropping back pretty heavily on the day we got those results, the 31st of May, they did end the week 5% higher. But you are still talking about the fact that its share price performance since the start of 2024 is down 20%. Now, you think about JD Sports, it does great guns on selling posh trainers to kids that maybe have more money than sense. Certainly, my daughter came back the other day with this box of very nice trainers, but when I asked her how much she'd spent, you're talking about £140. Dan, when was the last time that you spent 140 quid in a pair of trainers?
Well, I can safely say never. I was just, as you were saying that, I was just thinking, is this sort of situation like where you could sell the box on eBay, an empty box?
You probably could.
There's value in that.
But they keep them pristine in the boxes. So she's got these boxes of trainers now because she started working a year ago. So she's got her own money and she's able to save her money and invest in these things. And she chooses to buy a lot of vintage clothing, secondhand clothing. So she saves her money there, but she spends her money on trainers. And I think it's fair to say that JD Sports is a self-styled king of trainers. This is where it has really sort of captured the buzz of their youthful consumer. But it was fascinating because the chief executive, Regis Schultz, said that they'd had a really challenging time. They'd issued a profit warning in January. Things had picked up. Still a challenging market. Trainers is the absolute sweet spot for them, but apparel, clothing revenues are sluggish. And he was saying that these clothing makers needed to be more innovative. So trainer producers have just managed to capture their consumers' wants, demands. They use social media so brilliantly. They bring in amazing people to be the face of their brand and create these items which people are prepared to pay for. But Regis Schultz was saying that in terms of clothing, that just wasn't happening. Now, whether or not the fact that we've got this incredibly busy summer of sport coming up, we've got the football, we've got the Olympics, we've got Wimbledon, we've got cricket, that could really sort of shake things up a bit. And for JD Sports as well, they are expanding. So they've opened over 200 new stores. They're planning to open 200 more. They are branching out, particularly into the United States. They're looking to acquire Hibbett and Korea and, really making the most of their USP. I mean, they know what they are and they are going great guns, but they have fallen way short of the expected 1 billion profits that we were talking about just this time last year. Now, continuing to talk about the bad, B&M, in some ways, B&M Bargains, this is a store which really appeals to people that have been trading down. It sells loads of stuff. You've got DIY stuff. You've got laundry detergent. I was in there yesterday buying dishwasher cleaner stuff. And they're also now branching into food. So there were new food aisles in my B&M. And it has seen revenue up 10% to 5.5 billion. But there are now signs that its growth is slowing, which has impacted the share price today as you and I talk. And Inditex, we were just talking about clothing, is the Zara owner. That really just has created a masterclass in how to shift from fast fashion into the kind of fashion which people are prepared to pay a little bit more for, is still incredibly, and I'm using my figures here, inverted commas, fashionable. It does appeal to people that are looking for the latest trends, but it's got a bit of quality to it. So it's sort of set itself apart from a lot of its competition. And again, it's seen a 7% rise in sales. I think every time we talk about Inditex, it seems that there has been another rise in sales. And I want to finally end on WH Smith, because this is a fascinating retailer that's completely shifted. When was the last time you went into WH Smith, Dan?
About 2 days ago.
And was it at an airport?
No, I was with my daughter and we were just walking around and she said, "Oh, can we have a go and have a look in there?" She likes she likes stationery and stuff like that. So she's like, there is still some excitement. But there's always a bit of a joke, isn't there? That all they want you to do is to buy a newspaper and you get a free bottle of water and that, they're just, all you can see is water. And this store, it was just in Brighton. We'd gone for the day and they had, I don't know, 15 to 20 boxes of water, just randomly plonked everywhere. It's a very strange business model. And the design of the shop floor, massive spaces everywhere. They're not quite sure what to, I guess they must sell enough greetings cards and, whatnot, Mars bars to be able to keep the lights on. But you do wonder why they bother having some of these high street stores, really.
Well, our high street store has disappeared in Huddersfield just very recently. And I find it quite sad because I similarly loved going in and having a look at, the stationery and the books and that kind of stuff. The last time I was in one, again, was just a couple of days ago, but that was at Manchester Airport on the way to Spain. And that is where they have you, because you are just, if you want a plug, if you want a pillow, if you want a book or a paper or some sweets to deal with the ear thing when you're going out and coming down, then you are going to stop in on WH Smith. And they are expanding their travel empire. And that's the bit of the business that's going great guns. But you were writing about this morning. Toys R Us. I used to love going into Toys R Us with my little kids, and they would just run through the store and it would be piled high with shelves and shelves and shelves and shelves of toys. And in the run up to Christmas, it was just absolutely magical. So the fact that WH Smith is hoping to revive this brand fills my heart with a bit of glee.
I thought it was really interesting because it's clearly, as I've just given an example, they have plenty of space that they could use, or put to better use, I think is the correct way of saying. I think if they've got that brand still, whilst the Toys R Us company going into administration in 6 years ago, obviously that's a reflection that not enough people were shopping there. But that brand is incredibly strong. I don't know. Maybe it's with a certain age group. If you're, you're over 30 or over 40 or something, a lot of people look on it fondly. So I think that, probably quite cheaply, seems to have got the exclusive rights to use this brand in the UK. Let's see what they do with it. Yeah, I mean, I think it's because you don't really get toy shops. Certainly where I live, there's the Entertainer, but there isn't like somewhere, if a kid wants to go, I want to go and look at all the toys. What do? They go and browse through the Argos catalogue in a corner of Sainsbury's or something.
You don't have the catalogues anymore, though, do you? No. The Argos catalogues. I used to love doing that around Christmas. You'd go to Argos, you'd get a catalogue, you'd leaf through it, you'd fold the pages over of the things that you wanted, and you'd leave it on the table for mum and dad to take a look at.
Yeah. I think it's quite interesting because if you think what like people like Tesco did, they try things that they stuck a cafe in, or you might go and get your this is going back years ago, go and get your photos developed or something, that just better using spare space in a store. I think W. Smith's got lots of options to see what it could do. And if the Toys R Us sort of initiative doesn't work out, fine. I doubt they'll have spent a lot of money on it, because one of my absolute favorite Twitter account, which doesn't seem to be very active these days, was WH Smith Carpets. I don't know who runs it, but it's literally just pictures of it's pictures of flooring in WH Smith stores with all the tape. It's always got like gaffer tape, or it's just falling apart, things parred in the corner, and it was hilarious. Or the absolute shambles that is a WH Smith store. But yeah, anyway, sorry, we're talking about retail too long. Should we move on to our next topic?
Now it is time for Pensions Corner, and we're joined by Rachel Vahey, AJ Bell's Head of Public Policy. Hi, Rachel.
Hi, Danny.
Now, this week's question is from Emma, and it goes: my 66th birthday is in August. I'm currently still working, although on a part-time basis, but my income from that is sufficient to meet my needs for the meantime. However, I'm due to get the state pension in a few months' time, but don't really need the money. Do I have to take it? Could I delay it? Good question.
It is a good question. I'm going to start, Danny, by just rowing back a little bit just to talk about what the state pension is and when you can get it and how much it's worth. So the state pension age for UK adults is now age 66. So that's for both men and women. However, this is due to gradually increase to age 67 between 2026 and 2028. And then it's going to go up to age 68 in the mid-2040s, which seems quite a way off. But various governments are discussing about whether to bring that age 68 increase a little bit forward or not. So to get a state pension, you have to have a qualifying year for national insurance contributions. So all that means is that you're working and you're paying national insurance contributions for a full tax year, and you can get a qualifying year. Now, if you don't work, for example, you are unemployed, or you're looking after small children, or you're looking after other people, you can get a credit as well for this qualifying year. You need at least 10 qualifying years to get any sort of state pension. And to get the full state pension, you need 35 qualifying years. Now, if you fall short about that, and you can write to the DWP and ask them to tell you what your current situation is. But if you are falling short, you can always pay in voluntary national insurance contributions and just top that up. So when somebody gets to state pension age, they can claim the state pension. They don't have to stop working to do that. They can just take it, but it is going to be fully taxable. So if you add it onto any income they're getting from their earnings, it could possibly even push them up into a higher tax bracket. So they just need to watch out for that. From state pension age, though, you don't have to pay any further national insurance contributions. So that cost disappears completely. But you don't have to take it if you don't want to. You can defer it, and some people do choose to defer it. Now, if you do, what happens is you miss that state pension, but it increases, and it will increase to a higher amount when you do decide to take it. The amount it increases by is 1% for every 9 weeks you defer it. So that sounds really quite confusing. But if you look at it over a year, then it's roughly about 5.8%. So, for example, this year, their state pension is worth about 11,500. And if you deferred taking it for a year, that means that somebody taking it next year will get an extra £667. So that would push it up to a total of just over 12,150, roughly. They would then get this higher amount for the rest of their lives. So what you do is you forego one instalment, but you end up with a higher amount for every other year you're going to live and claim it. But because you are missing out on that first amount, it's going to take you roughly 17 years to break even. So the amount you're getting up from the higher state pension equals the amount you gave up in that first year.
That sounds like an awfully long time, 17 years before you can make that up. So is it worth deferring?
Well, whether or not deferring a state pension is the right option is really going to depend upon someone's personal circumstances. For some people, it's simply not an option because they need the state pension income as soon as possible. But for someone who doesn't need the income, like our questioner, like our reader, Emma, then it's going to depend upon their health and their lifestyle. So very broadly, if someone is in poor health, then it may be better to take the state pension. But if they are in good health and think that they're going to live beyond 17 years, then actually it could be worth considering. Another alternative to this, though, is that someone claims the state pension and then they save or invest it. So they put it into, for example, an ISA, or if they've got available allowance, or they could put it into a pension as well if they've got the contribution, if they've got earnings to support that. And very finally, somebody will only get their state pension if they claim it. The Department for Work and Pensions writes out to people about 2 months before state pension. So anyone deciding to defer it can either do nothing or at this stage ask the DWP to defer it.
It's such a murky world, Rachel. Huge decisions when you reach that age. Thank you so much for shining a light on that.
No problem, Danny.
Now, we've just had some new figures published that shed some light on how many people have put money into cash ISAs. Dan, am I going to be surprised?
I think you will be. £11.7 billion went into cash ISAs in April, according to the Bank of England. That is the highest inflow into cash ISAs since they launched in 1999. It's quite surprising, isn't it? If you think that, I can understand when we had a period, interest rates really high, everyone was scrambling to go, hang on a minute, I used to have to take the risk of putting this into equities. Now I don't have to take any risk, so I can get sort of 5% very easily with cash. So I'll chuck it into an ISA. Over the last, 6 months or more, as expectations for interest rates to come down, it's been really much harder to get a decent rate on cash as you could have done last year. So I presume that would trickle down into people shifting it back into equities. But no, it seems to be that the cash ISA is still so popular with people. But what's also interesting is that the average interest rate on instant access accounts is 2.1%. Even worse is that households still hold £251 billion in accounts that pay no interest at all. So, it's a very peculiar situation here. Why aren't people shopping around for a better deal? Don't know. Why are people still obsessed with cash? I mean, it's fine to have some cash. Obviously people like to have it for emergencies and stuff, but it just shows that if you perhaps a little bit of effort and a bit of thought about what do you want to achieve with your money rather than just letting it collect dust, you might be able to do, I guess, give you more options to do it. So AJ Bell did some sort of analysis to this, looking at there's a study that comes out once a year from Barclays called the Equity Gilt Study, and they give you sort of historical returns on cash and shares and bonds. So if you sort of essentially put £10,000 saved into a cash ISA at the beginning of 2014, it would be worth £11,222 after 10 years. So that's up to the present day. If you'd invested that money in a global stock market tracker, that money would be worth just over £30,000 now. Now, yes, there would have been much, fluctuations along the way, but if you tie money up for a long period, history does suggest that equities outperform cash. But I guess it's all to do with people's risk appetite. Of course, there's no guarantee that what happened in the past will happen in the future. But it really did take me aback when I saw all that money going to cash ISAs, particularly as we're seeing this shift in the landscape at the moment in terms of what you can get. I mean, does that figure surprise you, Danny?
It does surprise me, but it also doesn't surprise me. We obviously do another podcast, AJ Bell Money Matters, and I know certainly female investors are far more likely to plump for cash just because it feels more familiar for a lot of people. And, you handle it every day. And I think there's a lot of thought that, it's more risky to put into equities, and they don't look at those numbers and think about the potential opportunities. They think about the potential risks and decided, oh, well, I'm making a bit of money on my investment. But then when you factor in inflation, ouch. Well, our next guest has got certainly quite a lot to say about cash ISAs. So should we bring him on?
Yeah, I mean, there's been a lot of talk over the last couple of years about the need to get more people investing in the London stock market, get more money pumping through to smaller UK listed companies. Now, whilst that has been sort of a hotspot for takeovers in recent years, there's various sort of initiatives that trying to make things better. And one possible solution proposed by the Conservative Party at the last budget was a UK ISA. Now, there's been a lot of criticism about this initiative, but even critics agree something needs to be done to persuade more of us to invest in UK companies. Now, one fund that specialises in small caps is the Rockwood Strategic Investment Trust. Now, Danny recently caught up with fund manager Richard Staveley to find out why he's supportive of a new ISA. Let's hear what they had to say.
So I want to start by talking to you about the UK ISA. I mean, it could still go ahead if Labour wins the general election. We've heard from our chief executive, Michael Summersgill, on an episode a couple of weeks ago. Not a massive fan, big concerns that actually it won't do anything to bring more money into UK stocks. What's your thinking on it?
Well, I think it's actually quite a good idea. And I think that Labour probably know that too. I think that Labour, it's more important really that Labour have recognised as an issue with the UK stock market, which is something which is a relevance to all people in Britain. You want an attractive and active fund market. So I think that Labour trying to establish their credentials with business and with markets will be supportive, and we'll see this initiative coming through. I mean, the AIM market itself is down in terms of listed small companies in the UK by 50% in numbers in the last sort of 10 years. And the FTSE small cap index now only has 113 companies in it. Now, these are companies which are British companies, mostly on AIM and down at the bottom end of the market, who employ British people and pay British taxes. And the reality is we need to try and stimulate that market further. Now, and the ISA and all ISAs are obviously a tax break afforded to British citizens for Britain. So I think it's pretty fair that these tax breaks should be helped to be sort of delivered into British business. So I think my data shows that about 800,000 people max out their ISAs. Various levels of sophistication of those that do that. But if all of those do the initial suggestion that it would be a relatively low and paltry £5,000, I would suggest, in the grand scheme of things for the total ISA allowance. That would be a 4 billion amount of investment into UK equities. My view is that it should be higher, the amount. And if you say double that to 10, that'd be 8 billion, which would have a significant impact on UK stock markets. What's sad, really, to me, is that there's 300 billion of money invested in cash ISAs, which is a non-productive asset for Britain. And if we can try and just stimulate some of that money into British businesses, we're going to have a more vibrant economy, and maybe we can deliver better growth rates than we have in recent years. I'm obviously going to take this opportunity to say that Rockwood would be a perfect thing to do with your British ISA, because we're invested in 20 British businesses, all of which are small, across a range of education markets, manufacturing, construction, defence, and so we think Rockwood would be a really good place for people's Rockwood, their British ISA, if it comes to fruition.
Nice plug for Rockwood there. Just in terms of people using that new allocation, there is a danger, and this is something which could well happen, certainly something that AJ Bell's chief exec worries would happen, that people would shift their UK stocks, the amount that they invest in UK stocks, into this new allocation, and then max out their rest of their ISA with international stocks, with things like Nvidia, those magnificent seven, which do capture huge amounts of investor attention.
Yeah, I think some people might adopt that strategy. Obviously, if they're separate entities, you might mean you lose your ISA allocation and your main allocation in order to put it into the British allocation. So it might not be as seamless to be able to be done seamlessly. I think most people will see it as what it is, which is a British ISA to invest in the British stock market, which has a lot of attractions. Those that have made fortunes in stocks like Nvidia in recent years, maybe seeking to think, where the opportunities are next. So I think, British stock market might actually catch more assets than some will think. So I don't think it's as simple as that. I think it's very easy to look through it from a lens from a British saver perspective, and not from a British business perspective. And we have to have a thriving British stock market. If we don't have small British stocks, then we won't have medium size. We won't have big stocks. We won't have people being employed, and then we won't have the ability to save money. So I think if it's marketed correctly, explain to people what we're trying to do with it, and people understand the attractions, then I think there'll be less moving around than maybe the majority of the market will do.
Let's hone in on those small stocks then, because it does seem that gradually they are starting to come back into favour with investors. Now, it could be that it's purely down to rate cut expectations. Is there something else as well, though?
I think the rate cut expectations are very relevant. UK smaller companies in every other rate cutting period have done very well, outperformed. It's been a strong performance for UK small caps, and that's for two reasons. Firstly, the relative returns offered by small caps relative to a falling interest rate means there's, you just assets get switched across. And also it's typically seen as kind of stimulative activity for the domestic economy, which UK small caps have a much bigger exposure to than large cap stocks. However, I think in addition to that, there have been a lot of fears that we were going to go into a much more starker recession than clearly we've had. And when employment's remained okay, inflation's now on much better control, and consumer confidence has been picking up alongside improving real wages. So I think the backdrop is actually just generally things we may have escaped a much more serious outcome than people were predicting a year ago. I would say, though, that this sort of period of lack of interest in UK small cap is the anomaly. UK small companies have outperformed large companies for 13 of the last 20 years, and is by far the best performing part of the UK stock market over the last 5, 10, 20, 30, 40 and 50 years. So literally a pound invested in 1955 in the bottom 10% of the market would be worth over £7,000 by the end of last year if invested in the bottom 10%. In the bottom 2% of the market where Rockwood focuses, it would be worth £12,000. And that compares to large cap, which would be £1,500, all of which are great returns and show the benefits of investing in equities. But the small cap effect over the long term is absolutely massive.
With bearing that in mind, is it that for retail investors in particular, investing in small caps seems a bit scary because there's not as much information out there? You've got to do more work. Certainly, that they're not the kind of businesses that you see regularly talked about in the FT.
I think that's very, very true, Danny. I think that for an unsophisticated or an investor who hasn't got the time to put the work in, and I mean a lot of time to put the work in, then it can be very dangerous to invest in individual UK small company shares, particularly if you just pick up some interest from the newspaper or that kind of thing, and then just act on the basis of what you've been reading over your Sunday breakfast. So I would heavily suggest that for this part of the market, as with other specialist parts of world markets or whatever, you're better off finding a fund manager that dedicates their life to doing their best they can in that specialist area, who will buy a diversified portfolio. So I would suggest the best advice being is that investors, they can have some large cap stocks. There's nothing wrong with that. They're big, very diversified businesses. But alongside that, picking a small cap fund typically makes sense.
Let's drill down into Rockwood then, because it's been performing well over the last few years. What are you doing differently from other small cap funds?
Yes, Danny. Yeah, we are. As far as the small cap investment trusts go, we're the number one fund over the last three and five years. And what we do a number of things differently. The first is we do diversify, but we have about 20 holdings, whereas quite a few small cap funds have about 60, 80, some in fact over 100 holdings. And that allows us to really focus, a bit like Warren Buffett does, into the absolute winners that we can identify in this part of the market. And what that means is when our winners do well, they really win for the portfolio. They didn't get diluted down by the rest of a much wider portfolio. That concentration allows us to do a significant amount of due diligence prior to purchasing. So we have far less to concern ourselves with a much smaller portfolio. But it also allows us and gives us the time to get very engaged with the companies we invest in, which is a key differentiator for the Rockwood approach. So we have board positions on 6 of our 20 companies that we're invested in. We spend significant amounts of time. I mean, literally yesterday I was up in Walsall near Birmingham, seeing one of our companies, and first person to visit that new development and distribution hub that company has. And we also get engaged to create catalysts in the stocks that get them kind of moving to speed up shareholder value returns or optimization. The other couple of things which are relatively important to highlight is that we have a value bias, and actually quite a lot of the fund managers in the UK small cap space are kind of more prone to growth stocks, which is what naturally sounds sort of what you think about in UK small cap. And there is a lot of growth in small cap, but we look for value situations, turnaround recovery situations, which has allowed us to identify those and benefit from those during a difficult period. So I think Rockwood's share price is up now, as we do this recording, like 200% over the last five years. We think that's been delivered during quite a difficult period because of the types of stocks we look for. We also have an absolute mindset. So we don't have a benchmark per se. What we're looking for is to identify small caps that can double in value on a 5-year view, which delivers you about 15% per year through the 5-year holding period that we would have invested. And that kind of mindset is a bit different than some fund managers that worry about their benchmarks. Alongside that, we put our own money in the fund. So I own just over 1.2% of the fund. And Christopher Mills of Harwood, who runs Rockwood, has bought 27% of the fund. So we have our own money alongside investors, which I think really just means you've got proper skin in the game.
Yeah, put your money where your mouth is. But having that limited number of companies must mean sometimes you get it wrong, or sometimes the companies that you've got in your portfolio reached the end of the time that you want them within there. What have you been selling and why?
Yeah, very good question. I think two things to point out. Firstly, we believe that about 80% of our holdings will be taken over. And about 20% of our holdings will sell to another fund manager when their stocks have sorted themselves out, recovered themselves, rehabilitated, and a different style fund manager will buy it at a much bigger valuation. 80%, though, we think will be taken over either by trade buyers or by private equity. And indeed, we've had quite a lot of that in the portfolio in the last few years. In terms of selling, then, I mean, this is why Rockwood's quite differentiated. We've actually only put sell orders on in 2 holdings in the whole of this year so far. One was a company we started to try and buy, but couldn't unlock a proper enough, big enough stake for us to actually do what we wanted to do. So we decided to actually move on because we found another much better idea to do. And the second one was actually one that actually is exactly what you said. So one of the ones that didn't work out. There's a company called Argentex. And Argentex are a UK business that focuses on FX services to small and medium-sized businesses. Very profitable business, has grown lots over the last few years. But the evolving management team of the last 2 years didn't work out. And they got their costs out of kilter with the growth in the business. And they've had to have a big reset. And the risks as a result, the risks around the stock have increased with the new management team that have arrived. Now, the business still has net cash and still has strong prospects, but we felt the risks had increased a lot. So we had reduced our position. Again, in that as it stands in that business, you know, their industry is actually consolidating as well. There's a number of deals and potential deals that are both been happening or in play. There's another stock called Equals, which is currently under bid for. So we think that Argentex would have attractions to various industry participants. So we haven't completely exited, but at this higher risk point, it's the only stock in our portfolio we've actively reduced during this whole year.
I'm fascinated by the fact that you think 80% of the stocks that you hold are likely to be taken over. And on the one hand, clearly that presents a massive opportunity. But on the other hand, that suggests that here in the UK, we're not getting that scale up. We're not seeing those smaller companies able to stand on their own feet and move to that next level, which, you know, does fire a few warning signs.
Yeah, and that's exactly the kind of thing where funds coming from British ISAs might allow those companies to raise more money and then take themselves to the next level. Look, I think there's, in all markets, there is this sort of capitalistic sort of cycle of businesses that can't make it go or otherwise. I think we've had a higher tempo of takeovers in the last kind of 2 to 3 years because of people shunning UK markets. And that's opened up this huge valuation anomaly where essentially British shares are being valued at a big discount to where they have been historically. Huge discount. It's actually the largest discount since 1989 of UK shares versus global shares. So, under 250 million, the average market cap in UK small cap now is less than 10 times, less than a PE of 10. And what's happening as a result is these external participants, external players are seeing this opportunity. And just a few examples, I mean, literally, as I said, we only got 20 holdings. Last year, we had 6 takeovers. One of our companies was onthemarket.com. It was taken over by a NASDAQ company that's valued at over 20 billion. One of our companies was a pub company called City Pub Group. That was taken over by Young's Pubs, a trade buyer who know that the pubs were being massively undervalued on AIM, of City Pub Group. One of our companies taken over by an Australian listed company. And interestingly, we've just had, it's quite exciting, but one of our stocks in Rockwood is called Filtronic. And we think it's the first share that Elon Musk has actually got exposure to. He's actually taken warrants in Filtronic up to 10% of the company. And it's a technology company involved in the space industry. And Elon has become a large customer for them for his Starlink platform. So we think that these external parties are seeing this opportunity. Now, the reality is those takeouts might actually start to fall over the medium term if British equities start to become more back in favour.
Richard, I could keep talking to you for ages, but we've run out of time. Thank you so much for your time on the Money and Markets podcast.
Thank you very much, Danny. And I'd also like to thank AJ Bell hugely, because AJ Bell collectively shareholders make up in our top 10. So it's really important that you guys can all hear some of our thoughts. So thank you very much for those that have listened in.
So that was Richard Staveley from Rockwood Strategic. Now, we'd love to hear your suggestions for people to be interviewed on the podcast, whether that's a fund manager, a company boss, a personal finance expert, or more, anything to do with investing or money. Email podcast@ajbell.co.uk with your ideas.
Now let's bring on our final guest. Ross Driver is the Managing Director of Foresight Solar Fund, one of the many renewable energy investment trusts on the UK stock market, which have been going through a tough time over the past few years. There's some big news coming next week. So let's hear what Ross had to say when he met up with Dan a few days ago.
So, Ross, Foresight Solar Fund has got a continuation vote on the 12th of June. Could you possibly explain what continuation votes are? And, do they happen on a regular basis for investment trusts, or is this something that's been called by your shareholders because something that's happened specific to the trust?
Sure. Thanks, Dan. The continuation votes or discontinuation votes, however they're sort of framed in the articles of the companies, it's really a shareholder mechanism. And it really, how they're set up depends really whether they could be every 5 to 10 years, or they could be triggered by factors such as the fund trading as a discount to NAV. But it's an opportunity at the AGM for the shareholders and the investors to have a say. And effectively, it's a vote on whether the shareholders want the vehicle to continue in its current form. And a vote against continuation or for discontinuation would effectively be, and typically, it would usually take a large proportion in terms of majority or even a sort of 2/3 of shareholders to say that they want something different to happen with the fund. So they don't like the current direction of travel. For ourselves, as Foresight Solar and a host of other funds in the sector, this continuation vote has really been triggered by our share price trading at a discount to NAV. And that's no different from a lot in the sector. So it's actually more macroeconomic factors that are affecting the entire sector, not just renewables, the broader alternative asset class as well. And everything has been heavily impacted by the high interest rate environment and the largest leap in the base rate in about 40 years. Really, so that's come down, and it's heavily impacted the valuation of real assets and given investors pause for thought of other income sources at the moment. So that's a bit of the background on what's happening at the moment.
So, come the 12th of June, if we get a situation where your shareholders don't want the trust to continue, what do you do? Do you just you try and sell the assets and you just return the money to shareholders, or do you actually sort of seek a buyer or a merger partner for the trust?
Well, in terms of it will come down to, so listed trusts like ourselves have non-executive boards that we report to. I work for Foresight Group. We represent the investment manager who runs the day-to-day strategy ongoing, but all the decisions, the strategic decisions and things like this are made by the boards. We have five directors. So it would come back to a decision for the board to look at this and say what is in the best interests of the shareholders, which could be, options are a potential wind up, a sell down of the assets, a merger, or really a vote for discontinuation in this sense would be the shareholders want to see a different course of action. So it probably involved quite a bit of where we have seen larger votes against, quite a bit of reaching out and discussions with the shareholders to see what the consensus is in terms of what investors do actually want from that.
So, I mean, at the time of we're recording this podcast, the Foresight Solar Fund was trading about a 24% discount to the value of its underlying assets. So does that sort of wide discount make it likely that investors would vote in favour of winding up the trust? Because potentially they could get out at net asset value if you sell the assets for what they're valued at in the accounts.
Well, theoretically, in terms of that, and I'll just say the one thing I'd say, the discount that we're trading at is, I think, actually slightly under what the average of the sector is at the moment. So the wider sector, I think, is even higher and further out than that. So it's not only just ourselves, not necessarily in terms of that. And I think there's a couple of things here. And from the discussions, we are obviously been liaising very closely with our investors at the moment for those decisions. I think is one terms is I would understand it more if there was a fundamental issue with the trust and with the company itself. But as I go back to, this has impacted pretty much everybody in the sector, and it's macro factors that are at play here. And we probably had the most challenging markets that we've had since the great financial crisis back, what is it now? It's over 16 years ago. I remember that well when I was working. But actually, like I said, the steepest rise in interest rates from over 40 years ago, so there is real economic turmoil going on at the moment, and things do look like they're starting to correct themselves, and the worst of that is hopefully through. I think a lot of investors, and from speaking to them, are looking at this. It is painful for them, and I speak to them. I've been speaking to another one this morning. It is painful. It's hurting them and hurting their investors. But I think it comes down to whether you're taking a long-term view of these things and what decisions that the trust is making in terms of that. And from our side, I think we've been making great strides in delivering on our promises to investors to return capital. We've been providing we've been probably the most active in the renewable sector in terms of buying back shares and returning cash to investors that way. We're recycling a small proportion of capital into a development pipeline that we hope will open the door to providing NAV uplift and greater benefits for shareholders in the future. We have already sold down assets at a good premium to the NAV or the book value of those assets in terms of that, and use that to pay down the debt. So I think we are doing everything we can at the moment, that the levers that are available to us. And I think the other point we would say is that actually we're looking at it, we realize that the macroeconomic outlook has changed. You can't carry on as business as usual, and therefore we are focusing on a more of a total return strategy to the fund. And I can talk a little bit more about what that means. I'm not saying at the end of the day that some investors won't take that view, but I think there's a lot of long-term investors that we see in this in terms of saying, yes, it's challenging at the moment, but things will improve. So yes, will we have some investors that vote against? Probably so. I think it's unlikely that most trusts will get through this without some people voting against it. But it's also a little bit of a theoretical. It's not, as I said, these assets. It's not like selling a car as well at the same time. And if you do see a potential for the base rate to be dropping, there is a potential. Do you want to be selling the assets now, or is there a potential for assets to actually the valuations of these to improve at the same time going forward?
So you mentioned about you doing everything you can to progress with the trust, but I guess does it ultimately just rest on interest rates coming down to really get that discount to NAV to narrow, or is there something else like a wave of takeovers in the sector, or new government policy perhaps that might benefit what you're doing?
Yeah, well, look, I'm not going to lie, it will help. I think a clear path to rates coming down when there's been sort of teases in terms of the end of last year and things like that of when Bank of England in particular may look to cut rates, it has helped and lifted the sector, and it lifts all ships, really. It's a bit of a balance between this, because we're not saying there is a lot that we can do in terms of this, and I feel what we've been trying to do that in terms of the proactive approach that we've been looking to take towards addressing the discount rate. So I think you've got to do both. I don't think between the asset sales, the share buybacks, and everything else that we've done, the sort of modification to the strategy, I think helps. And I think we are trading at a tighter discount to a number of the peer group. The fact that we're in the sort of top half of that helps. At the same time, there will be factors that are outside of our control. So I think it's about positioning yourself in the best possible place for when, one market's turn, that will undoubtedly help. But you can't just sit around waiting for that to happen. You also have to show that you're being active and also doing the right thing by your shareholders at the same time. Outside of that, yes, there has always been the spectre of takeovers and things like that, but we're already a long way into this, and there's been very limited, actually, in other sectors outside, such as, REITs and the accommodation sectors and corporate. More corporate buildings and things like that, there has been a lot more takeover. There hasn't been as much in this sector. I think if you were looking for take privates, it's interesting. Maybe the higher debt levels aren't helping that as much. And it's not always, we've seen one or two attempts for sort of peer-to-peer mergers, but they haven't paid off either. So I think the thing is, consolidation may well help the sector, but it just doesn't seem like it's got the starter to get it moving at the moment so far. So what we can do is focus on what is within our gift, what we can do, and position ourselves in as good a place as possible. So
I guess if we don't see interest rates cut for a while, we could potentially see persistent discounts for alternative asset funds in general. I mean, in that situation, what you can obviously do everything you can to try and keep things ticking over, invest for the future and stuff, but it's still trying to, how could you win over an investor in this situation? I mean, do you think that the alternative asset sort of sector could go through a very tough time if you do see persistent discounts?
Yeah. And I think that it's what's causing those persistent discounts, and it is really the higher interest rates. And I go back to that. It's not just the higher interest rates; it's the jump and how quickly they went up. And look, there are expectations. Things will probably happen slower. It looks like, I mean, the day that we're speaking, we may well see cuts in the European, the ECB interest rate coming soon. Seems like it's going to take longer in the US. Big question mark about where the UK and the Bank of England stands at the moment. But I think the expectation is that we may see one or two interest rate cuts by this year. But look at it. We were very alive to that as both Foresight Group and the board as well. We're very alive to the fact that, look, we're working to a new normal now. Even if there are rate cuts, they are not going to go back to the lows of the last decade. I think that ultra cheap money is gone. And we covered this in our capital markets event a few weeks ago, is need to adapt to what the new normal is here. And I could see interest rates moderating and coming down a percent or so, or a little bit more over the next year or two. But you've still got to, what we need to do is offer a good spread versus what the underlying gilt rates are, or the underlying bonds or risk-free rates. And also, what can you offer alongside that? So I guess the thing is, this is a point for the sector as a whole as well, is why gilts may look attractive, but the benefits, particularly of the renewables and wider infrastructure sector as well, is we all pretty much have progressive dividend policies, at least. So which means that our dividends will increase every year and annually. We upped ours by 6% last year, and we have sort of up to that level of increase a couple of years in a row. We've been aided on that because we have a level of inflation linkage in the revenue stream that has come through as well. So unless you're investing in inflation-linked gilts that have a lower yield anyway, you're not going to get those similar levels of return. I think the key thing that we see, and the differentiator that we're looking to do, is offer this modest level of NAV growth at the same time. No, look, we're not expecting to be able to add 10, 20% year on year on year. You need to go after the big Magnificent Seven growth funds for that kind of thing. But what we think the focus for the last decade was very much looking at these renewable funds as pure yield cos. Where we see it is it should be a very high quality yield with a modest level of capital growth in the long term as well. And that's where investing in a development stage pipeline is what we're looking at. So we've got development stage assets now in both solar and BESS in Spain. We're looking at doing the same, particularly in solar co-location in the UK and select other European markets, that we can see that growth coming through. to add a sort of 1 or 2 pence per annum in terms of to the NAV value and shows some organic growth coming through from the fund as well. And I think if you couple those things up with a level of moderation of the interest rates, you will start to see investors will start to see this for the benefits of this sector and it being an attractive asset class. But you can't just sit and wait for things to return to where they were over the last 10 years. I do think near zero interest rates have gone for the foreseeable future.
That was Ross Driver from Foresight Solar Fund, and that is all from us this week in this packed episode. I hope you enjoyed the show. Don't miss next week's, as we have got the boss of UK-listed Gym Group to explain how the nation is spending big on fitness. Until then, thanks for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.